What's up, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to be going through Hasbro stock. This is a stock I started purchasing about a month ago. And as you can see here, I purchased 17 shares at an average cost of $58 a share. My position is a lot smaller than what I would have liked to build it out to be, but as soon as I bought in, it started going up. So, it is what it is. But we're going to go through what my bullish thesis is for this company. If you don't know, Hasbro owned a bunch of toy companies like Power Rangers, Magic the Gathering, Monopoly, My Little Pony, Nerf, Play-Doh, and Transformers. This is a $9 billion company, a current trailing PE ratio of 22, and then a dividend yield of 4.2%, which was also a incentive for me to buy this stock. If we want to do some research on what people are searching for as far as these brands go, we can see that brands like Monopoly and Nerf, they have been around for decades and decades. They're very old brands, and so they're pretty consistent. They don't have much growth in them. They're just pretty consistent games and toys that people buy every year. So the other things to look at here, though, are Magic the Gathering and Dungeons and Dragons, which over the last 5 years, we have seen some growth, especially in 2022. You can see these numbers have gone up quite a bit. So that is always a positive sign. So now if we get into... let's see here. Let's get into my checklist here. Number one is going to get a yes because the stock is down pretty significantly. Here's the last 5 years. It normally trades at around a $90 price point, you could say. That's probably where I would draw the line. And so when I saw it at $58, I said, okay, this is a great deal. I'm going to take advantage of this. So the stock is down. Number 2 and 3 is revenue and net income. Revenue is a bit easier to judge here because here's the course of out of all these years, you can see revenue has grown pretty consistently. They've done a good job with that. But net income is a little bit different. Net income is a little bit more volatile. I don't really know if I would. You could consider this growth. You could not consider it growth because they had their best year in 2016 with 550 mil, and in this past year we saw 428 million. So, and that was 5 years later, and it's kind of up and down. So this one is tough. It's kind of tough to say. I mean, if you look at the chart does gradually move up, so I guess you could say it's positive. But this, like 2020, I understand because of the pandemic, but 2018, that was another big down year. 2013, and then even 2017 doesn't look great, and 2021 I feel like that should be higher as well. So that is kind of get a no, but it's not horrible. Next up, we have the price to earnings ratio, and I put yes. It's going to get a check. It has a forward PE of 12, which is very cheap. If we look at the past for where the stock has traded, we can see here that the stock normally trades right around a 13 or 14, and from 2018 to 2022, the stock traded at much higher valuations from 26 all the way up to back to these levels of 10 to 15 or so. And that's why that was another reason for me being bullish on this, because I saw I was trading at a discount from where it hasn't traded at this PE ratio since 2017. So I felt like that was a pretty good sign as well. So that's going to get a check. Then we go to number 5. You could consider this company to be a little bit innovative or have a little bit of a moat because of their brands. They have a ton of brands. They have a ton of partnerships like with Transformers and stuff. But again, I feel like with those games and toys, those could easily, fall out of trend one year and new toys can come in, or, a lot of stuff can happen. So if it's just toys, I feel like it's not a very solid moat right there. So I'm going to give that a no. Then we have, is it a growing industry? Yes. Toys and games like that they're still growing. Kids want toys, so that's not going to go away anytime soon. How is their return on invested capital? Well, if we go to return on invested capital, which is right here, we could see return on capital employed. Kind of looks like net income, but really it looks worse, to be honest, because you can see at this period from 2007 to 2017, they had great numbers. It was 15 to 23%. Those are strong numbers. But why did it drop down to 8% in 2018 and it still hasn't gone over 10%? That is not too good. One thing I've heard a lot from other investors is that don't expect to have don't expect to get your returns on a stock to be more than the average return on invested capital. So if they keep up with this, 6 to 10% number, I wouldn't expect to get more than 6 to 10%. But since the stock has fallen so much, I think it is going to return to that $80, $90 price point, and I think there's some money to be made there. Not to mention the 4.5% dividend, or when I was buying, I think it might have been 5%. The dividend is also going to, be something nice to have. But return on invested capital is definitely not good. It should be over 10%. It should be more like 15%. And so they have some work to do there. And that's why I think 2022 last year, they got a new CEO. So it's been almost 1 year since he's been in. So hopefully he can change things around and make things better, but we will see. Growing free cash flow, we can look at that, right? Let's see, that chart is right here. This chart is good. It's not perfect, but it's definitely better than the net income chart, because as you can see here, it from 2009 to 2021, let's see, it's probably, what is that, like a 3x or so, a 4x on free cash flow. So it's pretty consistent. Those numbers look a little bit better to me, so that's going to get a check. Then we get diverse revenue streams. I put yes, just because of all the different, you could buy their toys in different stores. They have so many different brands. So that I would give that a check. Do they have more assets and liabilities? Yes, of course. As with most companies, that's not a hard one to hit. Equity. Is it over 10% of the market cap? Yes, it is. This is a $9 billion company. And so 10% is 900 million, and they have 3 billion. So they are good there. How is their share count? Let's see. We can find that chart over here as well. So here we can see that their share count has gone down, right? If you look from 1999 to, the early 2000s, and then to 2009 to 2015, they made a whole lot of progress. There's definitely been a lot of progress. And then in the recent years, from 2017 to now, it actually has been going up a little bit. But again, if you look at it over the course of the last 20 years, they've done a pretty good job. And, this could probably be temporary. Now, if this was to continue for another couple of years and it comes back up to, let's say 150 million, well, then, yeah, that might be a problem. But that's just something to keep an eye out for. So that's going to get a yes. Are insiders interested? No, they own 7% of the company, I believe. And then when we check what the insiders are doing in this company, what we will find is that they have not purchased any stock since April of 2022, and I believe it was in the 80s. So that has me wondering, why weren't they purchasing shares when it was in the 50s? Because here we have, two different guys. So this Christian Cox, this shares at $88 a share. And then this director was in April 22. So they didn't sell any recently, but still, why haven't they been buying when the stock is down so much? That's not a great sign. And then, do they have respectable management? That's hard to tell because we have a new CEO, so we'll have to see how he does. But as far as the return on invested capital and their net income, they have not been doing a great job over the last 5 years. So that is going to get a no. Do they have more current assets than earnings? Yes, they do. That's something I like to see. A healthy dividend? Yes. If we want to go to their cash flow statement, so remember, right now it's a 4.5%? Yeah, 4.2% dividend that they're paying out. And for a payout ratio, we can see that. Let's see, let's go right here. Cash dividends paid is normally around $350 million per year. And as you can see, their operating cash flow has been all over the place. But, I would like to think it's going to come back to this $600, $700, $800, $900 million point. But lately it's been about 400 million. So, which is still over their number of dividends they're paying out. Because as you can see here, now they're barely covering their dividends for this past year. But normally in traditional years, they're doing, double, if not close to triple, more so like double. They're normally doing about double in operating cash flow as what they're paying out in dividends, which is not a problem. It's a 50% payout ratio. That's totally good. But right now we're approaching like a 90, 95% payout ratio, which does not look good. But again, this could just be a 1 year thing, and hopefully they can return to healthier cash flows. hopefully because of the new CEO, and then yeah, then things will be good to go. Finally, is the company over 20 years old? Yes, I think it's like 100 years old actually. So all in all, this stock is a 12 out of 18, which does not complete or fit the criteria for my list because you're supposed to get 13. But for net income, you could even consider that a yes because there has been some improvement there. So we could give that a yes if we really wanted. Either way, this is a stock I bought and I am bullish on this. The way I look at stocks is you don't have to be married to them for the long term. So right now I'm just dating this stock. Okay, we're dating for a couple months, and as soon as we get to a fair value, I'm going to break up with this stock and put my money somewhere else to date a new stock. But for now, I think this stock has a great chance. The odds are in my favor for this stock going back to 80 bucks a share. And at my average cost of $58, I'm not too worried about what's going to happen. I'm already up 13%. So there it is. Now, if this stock goes back down to 58, well, then I'm probably going to buy more shares. If it keeps going back up and it comes to 75, 80 bucks, then I'm going to sell off my shares. So that is my analysis for Hasbro. Let me know what you guys think. Comment down below, and don't forget to subscribe.